We are entering into another session of the chapter Financial Management. And in financial management, we were talking about resources, we were talking about the sources from where we can raise the financial resources, the aspects regarding payment of dividend, aspects regarding investment, everything was said in this chapter. Now we are entering into another section of the chapter which is talking about the structure of finance in an organization, or the arrangement or the financial pattern which is followed in the organization, or how do we, or which all sources we are using and how much we are using. All these things are being discussed in this topic, and this topic is about capital structure. Now what is capital structure? Capital structure is nothing, it is financing pattern or proportion of use of different sources in the total capital. Financing pattern or proportion of use of different sources. Basically, the sources from which we are raising finance for an organization is from debt and equity. Either we borrow from someone or it is from the owners. In ownership fund, there are two sources, that is retained earnings and the capital contributed by owners fund, that is through equity shares. Basically, equity shares and retained earnings are owners fund, and rest are debt sources. So capital structure is talking about the proportion of debt and equity in the total capital of the company. That is why we are saying it is the financial pattern of the financial sources in the company. Now, in other words, we can say it is the mix between owners fund and borrowed fund. It is the mix between owners fund. It is combining the fund of owners and combining the fund which is borrowed from others in a proportion, and that is what is called as capital structure. And we have to keep in mind that it is affecting profitability and financial risk. It is affecting profitability and financial risk because when we are raising funds through equity or owners fund, when we are raising funds through borrowed fund, both are having problem. When we are getting the capital through debt, there is chance where there is fixed financial charges we have to pay. We have to pay the interest. We have to pay the interest that too regularly. Considering no other factors, every payment of this amount has to be paid. So there is a risk factor. There is a risk that is fixed financial charges. And if we are not having enough return, if we are not having enough cash inflow, there is a chance that we may fail to honor that financial obligation. We may have a chance for non-payment of that financial obligation, and that results in non-payment of this financial obligation. And chance of this non-payment of financial obligation, we call it by the name financial risk. There is chance of non-payment of financial obligation. There is chance of non-payment of financial obligation, and that is called as financial risk. Financial risk is a chance. Financial risk is a chance which can happen in the business. We may fail to meet the financial obligation which we have to make, and that can happen. So when we are taking funds, through debt sources, there is chance of financial risk. Fixed financial cost has to be paid, more risk has to be paid, more risk has to be borne. So there is problem with borrowed sources. When we are going for fixed owners fund also there is problem. When we are going for owners fund, the problem is that we may have to spend more of cost. When we for issue we have to spend a lot of money. For issue of debentures or shares we have to spend money. Again there we have to spend, overhead cost will be very high. So there is a problem there also, but still we have to combine it in such a way that it is not affecting much, or this negative effects are balanced. So that is what is to be kept in mind when we are combining this financial sources, borrowed fund and owners fund. And the presence, or what to say, the proportion of debt in overall capital, proportion of debt in overall capital is termed as financial leverage. So when we are combining, there is a concept called financial leverage, and when we are adding more of debt, when financial leverage is increased, the cost will come down. Cost of funds will come down, because we have, or because it is cheaper source, but there is a problem with that. Financial risk will increase. So financial leverage, that is also a concept which has to be kept in mind. The proportion of debt in overall capital is called financial leverage. The chance of non-payment of financial obligation is called financial risk. When financial leverage is increased, there is a chance for financial risk, more of financial risk. When financial leverage, when debt is increased more in the overall capital, there is chance for financial risk to increase. So just keep in mind these two things. Okay. Now, what are the factors which we have to consider when we are going, or when we are forming a capital structure? There are certain factors which we have to keep in mind when we are making a capital structure, when we are combining debt and equity. The first factor is that cash flow position. Cash flow position is to be considered when debt and equity is increased, when debt and equity is combined in the overall capital. We have to keep in mind, the first thing is that the projected cash flow is to be considered, and we have to make sure that there is enough cash flow to meet a financial obligation. If it is more of debt in that capital structure, we have to make sure that there is enough funds to pay the fixed cash obligation, and at the same time it is not just enough to pay fixed financial obligation. There must be something more, there must be buffer, more must be there, and company has to meet financial obligation basically for three things. One is for normal business operation, investment into fixed assets, and third one is for meeting debt service commitments. That means principal to interest and repayment of principal amount. So these three things, company must make sure that there is enough money to pay the financial obligation, there is enough money to invest. So cash flow is to be considered first and foremost when they are preparing a capital structure. Not just enough to pay the financial obligation, there must be much more. That is the first factor which we have to consider. Second one is called as interest coverage ratio. Interest coverage ratio, it is a it is a method whereby we are trying to see, by which we are trying to see how many times earnings before interest and tax covers interest obligation. That means how much earnings of the company, or how much earnings company is making, and how far it is able to, how many times it has capacity to cover the interest obligation. The earning company is made whether it is capable of covering the interest obligation. How many times? Each time when it is more, if it is 2 times, if it is 3 times, if it is 4 times, company is in a better position. The higher the ratio, lower the risk of company to pay fixed financial obligation or interest payment obligation. So, company is making sure that whether the firm, by calculating interest coverage ratio, we are making sure that company have a capacity to repay the interest obligations, and it is calculated using ICR is equal to EBIT by interest. EBIT by interest, where EBIT is the earnings before interest and tax. When it is divided by interest, we will get how many times company's earnings can cover the interest obligation, interest payment obligation. So, that is another factor. We are trying to see how far company is able to cover the interest obligation. Considering ICR, we have to go for preparing capital structure. Again, debt service coverage ratio, DSCR. It is almost a calculation whereby we are trying to find not only the interest, it is trying to total cash required for paying debt as well as for preference capital. The cash profit generated by operations are compared with total cash required for service of debt and also for repayment of preference share capital. So, there in ICR only interest obligation was considered. Here we are trying to see whether the earnings what we have made is able to make us able to pay back the preference share capital also. And when DSCR is high, that means company has potential to increase debt component in capital structure. If DSCR is more, company can increase more of debt, because company has capacity to pay back debt as well as preference share. So, DSCR is another factor which we are considering. Again, return on investment. Now, return on investment means for the investment what we have made, what is the interest level, and if ROI of a company is higher, it can choose to use trading on equity. Return on investment. Trading on equity is a concept whereby we are introducing or we are increasing the debt factor or debt sources in the overall capital. We are increasing the financial leverage so as to have an increase for equity shareholders. So, trading on equity can be used when there is much better return on the investment we can, because we are in a capacity to pay the fixed financial charges. When debt is increased, automatically we are able to pay fixed financial charges, and thereby we can increase the or there will be an increase in earning per share, because once the fixed financial charges is paid, rest is for payment of dividend, where earning per share will be more. So, if ROI is a company is higher, it can choose to use trading on equity, and its ability to use debt is greater. So, that is another factor whether we are getting better return on the investment what we have made. That is also another factor which we are considering. Next factor is cost of debt. Cost of debt. If they are able, if company is able to borrow at a lower rate, cost of debt means the interest also is to be considered. The interest which we have to fix a financial charge we have to pay. To borrow at a lower rate increase capacity of company to employ more of debt. If company can get at a lower rate of interest, company can include more of debt in the capital structure. So, cost of debt, that means the interest rate of debt is also to be considered, is another factor which we have to consider when we are preparing capital structure. Again, tax rate. Tax rate is a deductible expense. Tax rate is a deductible expense. So, when higher tax rate is there, automatically debt will become cheaper. Debt will become cheaper, and because automatically it will have a less effect. It's a deductible expense. Cost of debt is affected. If the tax rate is less, which can be deducted, that means it can increase attraction. It make debt relatively cheaper because the interest which we are paying can be deducted from the deducted for tax calculating purpose. So, their debt can be considered as an attractive source by company, because automatically that becomes a deductible expense when tax calculation is made. So, again, considering to equity, debt become more preferable for companies. Cost of equity. Cost of equity means when equity is being given, automatically the owners will expect to get a rate of return for the risk they are taking. And when company is increasing debt, there is chance for financial risk. You have to keep in mind that if we are using debt beyond a particular level, there is chance for higher financial risk. But there is a positive effect. That the share price will go very high. And to make sure that return may go very high, and there is a chance that fixed financial charges also increases more. When more of debt is used, fixed financial charges increase more. Of course, it adds on to equity shares, the price of the dividend of equity shares, the benefit for equity shares increase. But if company doesn't have much of profit, or if earnings is being made, majority of the earnings will go to payment of this fixed financial charges. The remaining will be comparatively very less. So, cost of equity is to be kept in mind. When we are increasing more of debt, there is a chance that even when earnings are being made, majority of the earnings will go to repayment of this fixed financial charges. So, cost of equity, there is a chance to come down. Even when share price, cost of equity go up sharply, share price may come down, because this amount can have an effect. After fixed financial charges, the amount remaining will be only available. That can be comparatively lesser. And next one is flotation cost. Next one is flotation cost. What is flotation cost? When company is raising finance through various sources, there is an amount which we have to spend for this fundraising exercise. This fundraising requires cost. For example, when we are taking a loan, there is no much amount to be spent for raising that loan, only some procedures. But whereas when we are raising funds through equity shares or debentures, there are certain amount of funds which we have to spend in that fundraising exercise. That is called as flotation costs. So flotation costs are to be considered. Flotation costs are to be considered because when we are comparing debt with equity, debt have less of flotation cost, whereas when we go to equity sources, there is chances for more of flotation cost, or flotation cost can go high, which can affect companies raising capacity. So automatically flotation cost, the fundraising cheaper costs are to be considered. So fundraising, when we are going for fundraising exercise, this flotation cost is also considered. Again, risk consideration. Risk consideration, I said about financial risk, there is chance of non-repayment of financial obligation, that is financial risk. But there is something called business risk, which can happen due to various operations. We can call it as operating risk. Every business has some operating risk. So the total risk of a fundraising exercise, or total risk of business, is basically the financial risk and the business risk. This both risk has to be considered. If a firm's risk, financial risk as well as business risk is comparatively lesser, if a firm's business risk is lesser, it can apply more of, it can use more of debt, but there is a chance of financial risk. So the firm has to consider the risk factors, basically business risk factors, and at a later stage financial risk factor also has to be considered while going for capital structure. Flexibility. If a firm is using 100% of debt sources, it cannot go for debt sources further. So there must be always a flexibility. Nothing must be used in 100%. Nothing must be used in 100%. So that is also to maintain flexibility, they must maintain some borrowing power. That means there must be combination of debt and equity. And control factors, as we have said in earlier some topics, we have said if control is to be in the hands of few, they have to go for less of equity sources and increase more of debt sources. If it is vice versa, they can go for more of equity sources and less of debt sources. So control factor is also another thing we have to keep in mind. Again, coming on to regulatory framework. Regulatory framework means framework which is formulated by law. So we have to keep in mind that from banks and financial institutions, when we are raising, there are fulfillment of norms required, and according to the methods, there are specific methods to be followed. When we are issue of shares, they have to follow SEBI guidelines. When they are raising funds, when they are borrowing funds, there are certain procedures which have to follow. So regulatory framework is also to be considered. There are certain regulatory frameworks which are much more tedious, which more confusing. So according to the regulatory framework, according to the capacity of us to fulfill the regulations, rules and regulations, we may opt for different sources, debt or equity. Again, stock market conditions is another one. As we all know, there is bullish trend, bearish trend, and stag. So when there is a bullish trend, there is chance of share price to go high, and people may have that encouragement to go for purchase of shares. So, it is a favorable time where we can use more of equity, but when it is a bearish trend, company may find it difficult to raise funds through shares. So, it is better to opt for debt during a bearish trend, whereas bullish trend we can use more of equity. And the last one is capital structure of other companies. Capital structure of other companies which are doing business in the same area. It is better to follow almost the same method. Care must be taken that a company does not follow norms blindly, but we can opt if it is good, if it is found to be better, or if we have the same capacities, same way of doing things, it is always better to follow almost the same capital structure framework which is followed by companies of the same business. So, these are the factors which we have to consider when a company is deciding upon the combination of debt and equity in its overall capital.